Hello, everyone. Welcome to today's episode of the Macrocast. I'm your host, Ylan and Managing Director at Penta. Brendan Walsh of Markets Policy Partners is steering the ship with me today as well. John Fagan is out. Our guest today is Neil Irwin, Chief Economic Correspondent at Axios, author of The Alchemists, a book on central banking in the 2008 financial crisis, as well as How to Win in a Winner-Take-All World. Most importantly, he's also a very dear friend and taught me everything I know about macroeconomics, the Fed, the jobs report, which we'll talk about in just a little bit. So thank you, everyone, for being here today.
Thanks, Ylan.
Great. So let's go ahead and just dive right into the jobs report. That's the big news of the day. The U.S. economy added 209,000 jobs. Seems like a pretty decent number, but certainly below what markets were expecting and the slowest growth we've seen since the pandemic ended. The unemployment rate ticked down to 3.6%. Average hourly earnings were up to 4.4% over the course of a year. Neil, like I said, you taught me this 10 years ago when we were covering the financial crisis and both working at the Washington Post. So let me just kind of go full circle here and ask you, what jumped out to you in the data today?
Yeah, these are a good set of numbers. I wouldn't make too much of the payrolls number coming down. That's actually kind of what we want to see at this stage in an expansion. We're at full employment. You're not going to keep adding 300, 400,000 jobs a month like we were seeing last year. So that deceleration in payrolls growth is actually kind of a healthy thing and what we want to see. And the details of this report are good. They're solid. As you mentioned, the unemployment rate edged down to 3.6%. Employment to population ratio steady. Americans are still working. People who want a job are able to get one. Wage growth 0.4% month over month. Revisions to the previous month, as you said, I think it's 4.4% over the last year. That's a healthy rate of wage growth. Maybe a little higher than the Fed would like to see as they try and bring inflation down. But that does mean that Americans are seeing bigger paychecks as inflation comes down. So all in all, I say this is a healthy labor market, and this jobs report supports that idea.
Brendan, what are you seeing here? What do you think about the mix of where we saw job growth across industries? It seemed like healthcare and government were the big drivers here. Some of the trade and transports, maybe even mining, construction didn't seem hot. So it seems like there was some hot spots and some cold spots in the economy.
Yeah, definitely. And it's been that way for the last couple of months where the jobs that in the pandemic that, the construction and manufacturing jobs, those have kind of slowed down. And the ones that it was hard to hire and the things that got shut down are kind of catching up. But the fact that retail trade was negative kind of shows, I guess, that, we've kind of filled the glass back to kind of where it needs to be kind of back to a normal economy after, the weirdness that the pandemic caused. The other only two kind of leading indicators that I've noticed. Temporary health services have been negative for the last couple of months. That can be a little bit of a leading indicator that, things are slowing down. And also, we did have a negative 111,000 revisions the last 2 months. So it tends, when you start to see negative revisions, that can be a little bit of a leading indicator that the overall economy is slowing. It's not, that we're falling off a cliff, but in my experience, those can be a little bit of a canary in the coal mine that, things are actually slowing.
One more fun detail about this report. This was the first time in 14 months that the payrolls number actually undershot the analyst forecasts. That was a remarkable stretch where the number had overshot for more than a year every single month, and now finally undershot for once.
Does it say more about the data or about the analyst forecasts? I'm not really sure.
Yeah.
Well, what it says is that the consensus has been too pessimistic on the job market for years now.
Yeah. Right. Yeah. And I mean, there are parts of the economy that are weak, but overall the economy is okay, and people just don't really want to accept that,
And that a slowing economy or a slowing pace of hiring is actually an okay thing, as you were alluding to, Neil, right?
Well, the other thing is, it's very easy if you work in media or tech or finance to look around and say, oh, Goldman Sachs is doing layoffs. Google's doing layoffs. These big brand name companies who are cutting back, who maybe overhired during the pandemic period. But those companies account for a very small slice of the economy. And, if you look in, heavy manufacturing, if you look in any leisure and hospitality, any number of industries, things are hopping. And that hasn't changed, even though the payroll numbers are starting to edge down.
Yeah, and the tech layoffs were in sales and marketing. It's not like they're laying off the engineers and the coders. That part of the business is still doing quite well, and there's a shortage of those people.
How can you launch Threads if you don't have the engineers and the coders, right?
Exactly.
I mean, it's really critical to the fabric of American society. But in all seriousness, one thing that I did think was interesting, though, and Brendan, you mentioned this, is that retail trade was down. And I felt like that was surprising to me because the consumer has been such a backbone of the post-pandemic recovery, has been remarkably resilient. And is that perhaps a sign that, consumers have finally bought enough stuff? I mean, maybe they're still going out and getting their nails done or going out to restaurants, et cetera. But that in terms of the number of goods they have, we're all sitting in crowded homes with too much crap surrounding us.
Yeah, and there is data showing that credit card lines are increasing, so people are borrowing rather than spending out of the savings, and also tapping into some of the retirement savings. So those are a little troubling. But in the end, people still have jobs, so you can adjust your savings. It's not that you have to go bankrupt. I think that's a similar thing to what we'll see when the student loans happen. I think it's an average of $350 a month, and it really stinks, that you can't spend that $350 on, going out to clubs and restaurants. But the people do have the money to pay it,
Yeah, the hiring is slowing, but also it seems like that there is an impact to the hours that that employees are working as well. I think that the work week actually ticked up, but there was another line in the report that jumped out at me that showed that the number of people who are working part-time for economic reasons, meaning that their hours were cut because of slack or because of loose business conditions, that number actually increased by 452,000 to 4.2 million in the month of June.
Wow.
So again, is this one of those leading indicators? I know, Brendan, you've often mentioned, we should look at temporary services as another canary in the coal mine to see if businesses are starting to cut back, because you always start with the folks who, aren't formally on your payroll first, right, before you get to the sort of core employees. But, if folks are starting to see some of their hours get cut, they still have jobs, but maybe they can't work quite as much.
Yeah. And that's one thing that the Fed has, cited as why they need to keep hiking is, wage growth leads to inflation. So we are seeing a cooling in both hours and wage growth. So I'm not sure that it's going to change. I'm not sure that this jobs number is going to change what they're going to do at the next meeting. But, there is signs that, all this tightening is having the intended consequence of slowing inflation, wage growth, and the overall economy.
Neil, is there a level of job growth that you see as consistent with a cooling economy? I mean, I think you said that 209,000 is still maybe a little too high. I mean, I remember the days when we were all praying for 200,000 jobs per month, right? That was like the gold standard. We were hoping that we would get there. What is a sustainable level now?
So it's interesting. When you and I started doing this 15 years ago, the numbers that got thrown around are kind of steady state, keeping up with labor force growth, was something around 125,000, 150,000 jobs a month. That has come down because of a different demographic reality in the 2020s. The baby boom generation is retiring. The generations Gen Z coming up into the labor force is a smaller generation than the millennials. So and immigration rates have been lower during the pandemic. So for a lot of reasons, the underlying pace of labor growth, just if you look at demography, is slower, something south of 100,000 jobs, maybe 75,000. You can debate the exact number. Either way, 209,000 is a lot is clocking a lot higher than that. That said, I will add, one thing I think we've learned the last decade is that exactly what the labor force potential is really an uncertain target, and we don't really know how many people might be coaxed into the workforce when there are abundant jobs, good wages. Just this month, in June, we saw the prime age EPOP, employment population ratio among people 25 to 54, went up 2 ticks, went to 80.9%. And that's still a full percentage point below the all-time high, which was back in the spring of 2000, 23 years ago. So, there is the potential that there are people out there who might be pulled into the labor force if we keep this good job market going for longer and don't get a recession.
I think it's such a good point. Like we have the best labor data in the world, and we still don't really understand our jobs market at all.
Yeah, and I feel like it's one of the arguments that folks who wanted the Fed to hold on raising rates too quickly, back before obviously this big rate hike cycle made, was that many people believe that if we got the unemployment rate down to the three handle, we'd see inflation just start to skyrocket. And, for a long time, we didn't actually see that happen. What we saw was many people entering the workforce, a lot of people finding jobs. You can say that this period of inflation is, evidence that maybe the Fed waited too long, but there's a balance, right? Because the other half of the Fed's mandate is not just price stability, but maximum employment. So a lot of people who may not have been in the labor market previously can find jobs, can find good jobs, perhaps, and can be more productive members of society. So that's the tricky balance that the Fed is trying to make here.
Yeah,
well, and, I think
the San Francisco Fed actually just put out a report that they said that we find no evidence that their wage growth and inflation there's no correlation between wage growth and the CPI.
And I'll add, when I was learning economics as an undergraduate, when I was a young reporter in Washington, it was taken as kind of this gospel that NAIRU, the non-accelerating inflation rate of unemployment, was something like 5 or 6%, meaning if you got below that, inflation is inevitable. What we saw in 2018, 2019 before the pandemic it's just not so. We had sub 4% unemployment for more than a year back in that period. And if the pandemic hadn't happened, who knows what would have happened. But,
right.
It's hard to tell a story where the inflation we got starting in 2021 was a result of the unemployment rate being too low in 2019. And so figuring out what those levels can be and how tight the labor market can be without bad things happening, I think is, just an uncertain question.
Brendan, how are the markets digesting some of these numbers? I mean, it was the non-farm payrolls numbers was below expectations, but it doesn't seem like it's, really spooking the markets much at all.
Yeah, yesterday after the huge ADP number, the markets are down a little bit. It wasn't the end of the world. We're up a lot on the year. But today, it's a pretty good number. Today was kind of a Goldilocks number. It's not so weak that you have to worry that, the economy is so bad that earnings are going to be weak. But it's also not so strong that you have to worry that the Fed needs to over tighten. So the market's taking it pretty well. But the equity markets are kind of fine. But more importantly, this week we saw a huge move in Treasury rates. So especially the 10-year. So that really very much repriced that, and that had a little less to do with the data and much more to do with Fed speak and the minutes, which showed that the pause really was a pause, and they do kind of have consensus that by the end of the year, the majority feel that they need to at least raise a certain amount higher. They didn't specify exactly how much.
Yeah, in the bond market, we've basically done a full round trip now, where the drop in yield.
It's a different story, right?
Right. Well, back in around Silicon Valley Bank in March, yields just plummeted as people were betting that, okay, this is going to cause a downturn, maybe cause a recession, a credit freeze up, and the Fed's going to back off rate increases and maybe cut rates. And that is now fully reversed. We're now back over 4% on the 10-year Treasury. Mortgage rates are going to be moving in lockstep with that. Yep. And so we're back in that high rate environment that had gone away for a couple of months there.
And all the price hikes that were priced in at the back half of the year are priced out. So the market has finally accepted that the Fed, while they don't expect the Fed to hike as much as the consensus dot plot says, they are the market now is reprice that the Fed is going to hold rates for a long time.
Yeah, markets finally believing them, believing what they say.
It took a year.
Yeah, I think this is a testament, though, to Jay Powell's clarity of communication and saying, rate cuts are not even on the table, not even something that they're looking at on the horizon even. So, the expectations by the market that there could be rate cuts as soon as the summer, I mean, that's completely reversed. I mean, we're seeing exactly the opposite happen, is that markets are saying now, okay, we understand the Fed is going to, if not hold steady, actually hike rates even more.
The other thing that I think has been interesting, there was a lot of doomsayers, so the Fed is reducing the size of their balance sheet, but simply by not reinvesting the securities, it actually does roll off pretty quickly, because what they bought was the kind of the front end of the curve. And then we also have the Treasury issuing a much larger amount, because we have to pay for all the pandemic spending that we did. So a lot in the market thought that this reduction in the Fed balance sheet and then the issuance by the Treasury would result in the stock market selling off, because there wouldn't be enough money around for people to buy. But that just hasn't been the case. The Treasury market is functioning perfectly fine. Each auction goes kind of below the bid, and equities are hanging in there. So going back to, everyone thinks that the economy is terrible. Most people in the market also think that the market is terrible, and it just kind of keeps grinding higher.
Well, this is a good point to take a little bit of a break. When we come back, we will talk more about the Fed, how it might be processing the jobs report. We'll dive into the minutes of the Fed's last policy setting meeting, and we'll look at what's on tap for the week ahead. We'll be right back.
On the first Friday of every month, Penta analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at pentagroup.co or on Twitter at PentaGRP.
And we're back with the Macrocast. The jobs report is one of the most important data points that the Fed watches. Of course, as we said, half of their dual mandate. And we saw in the minutes from the Fed's last meeting that the job market is one of the reasons that some Fed officials could have supported another rate hike last month. Neil, what do you make of this division within the Fed? It seems like there's really a strong hawkishness among some officials.
Yeah, I mean, I think you can look at the last policy meeting in June, where they took a pause, they took a break from rate increases, and the communications that followed that, as this elaborate balancing act that Jay Powell and the leadership of the committee are doing. They're trying to keep everybody on sides. They don't like it when there's dissents. They want everybody to be able to feel comfortable with the decision. And the compromise, to me, looks pretty clearly like the Doves got a pause. The Hawks got assurances that there will be probably a couple more hikes this year. And I think you can view all the communications since then through that prism, whether that's Powell's testimony on Capitol Hill 2 weeks ago, his appearance in Sintra and in Madrid this past week, and from some of the other committee members who've been out there speaking. You're right. There's always divisions, right? There are always Hawks, there's always Doves. And I think people say, well, why'd they pause? Well, that was the goal, to keep everybody on sides. And, we'll see. It looks like they'll do another quarter point on July 26th and maybe one more after that. But, I also think there's a little bit of not fatalism, but a little bit of a sense that, we're going to see what happens. And we need to see inflation actually come down. We're not going to just believe our models and our forecasts. We need to see inflation actually come down to really say that the job is done. The rate raising campaign is over. And until we see that, they're going to, keep their focus on rate hikes.
But I think that's interesting, because, they meet for 2 days and then they vote. But it seems like the real negotiations happened the weeks before the meeting, right? Especially for Chair Powell in big events like this. Yeah.
And Powell, I believe he tries to speak with every committee member or participant privately on the phone in the couple weeks before a meeting. So, yes, you read those transcripts. Yeah, there's discussion, there's debate, but the decision's pretty much made by the time they show up in that room and get around that huge table.
Yeah, I thought it was interesting because it made me feel like maybe June was a little bit more of a jump ball. Powell's preference was clear, but others were kind of chomping at the bit, both one way or the other. Seems like July is now inevitable, but maybe September is more in play. And I wonder if if two more rate hikes by the end of the year is really enough. It seems strange if they would hike in July and September, but then not move again until 2024.
I mean, a lot of weight is being put on this narrative that market rents have been coming down, and that's going to, over time, bring core inflation numbers down. It's clear that market rents are softening, and that should be a disinflationary force. At the same time, you kind of want to see it in the data. You kind of want to see, real evidence that the inflationary psychology is contained and shifting downward. And look, we've gotten some signs of that. The Conference Board consumer confidence numbers, the Michigan sentiment numbers, and expectations numbers for inflation have come in. So there are some good signs, but I think they feel so burned. Back in 2021, they talked about transitory inflation, and here we are 2 years later, still with 5% inflation. So they really don't want to make this mistake of declaring victory too early, given the policy errors of 2021.
And Brendan, one thing they also pointed to as another reason to sort of assess the landscape at the last meeting was the potential impact that the lingering effects of the mini banking crisis could have on financial conditions. You follow that pretty closely. Are you still seeing any signs of turbulence?
No, not really. So we have seen a big pullback in commercial real estate lending, but that has to do with commercial real estate market, not with the mini crisis. And banks are a little tighter, but that very much has to do with where we are in the cycle, and also it has to do with the consumer. Rates are higher, so people are taking out less loans. But there's no, if you need a loan and you're a qualified buyer, you can get it. And next week we will start the earnings season, so we'll hear from J.P. Morgan, Citi, we'll hear from all the big banks. But Jamie Dimon was talking at an event yesterday, and he still sees the economy as fairly strong.
The other factor you mentioned in terms of commercial real estate, that's also another question mark around the economy, and there are a lot of Fed officials who have been sort of warning that could be another shoe to drop. Neil, what do you think? Is that something that's on your radar screen that you're watching as a potential landmine?
Yeah, it certainly is out there. And that was a factor in the 1991 recession, for example, a real commercial real estate crisis that did factor into that recession. That said, look, bad stuff can happen in the economy without it causing a recession. And if people who own the equity tranche of an office building in Midtown Manhattan, lose their shirt, and the debt holders take over and either, find a new buyer or just manage the building or turn it into apartments, that's not the end of the world. Somebody lost some money that they'd put at risk, and move on. The question is, do those losses impact certain segments of the banking system so severely that it impedes other lending in the economy and the flow of credit? And, is it possible the numbers get big enough and especially big enough for kind of mid-sized banks that it causes broader credit issues? Maybe, but I think people are getting way ahead of things in being certain that this is something more than just some losses for people who had, investments at risk.
And this also will play out very different than the crisis in 2008, where just overnight everything dropped immediately. This is a very much a slow moving kind of crisis, because the companies that are leasing the office space are still fine. They're paying their rent. They just want to have a smaller footprint. So you have to wait till your lease ends, and then you move into a smaller and nicer apartment building. So it's not like in September we realize, oh my God, this is the end, and everything defaults. This is very much a unique situation where some properties are great and some properties are obsolete, and it's going to take us 2-3 years to fully realize these losses.
Yeah, I think, Neil, too, something that you said just now really resonated, which was bad things can happen in the economy without a recession happening. And it seems like, again, if we come through this year unscathed, and despite what happened with Silicon Valley Bank, et cetera, that could be a good example of something bad happens, but the economy remains resilient. So to me, that kind of gives me more hope that there's a chance for a soft landing in our future, that all of these sort of headwinds of higher rates, of a slowing job market, of commercial real estate, of, banking turmoil, perhaps, that the economy can weather all those things without too much pain on the part of households.
Yeah, I think Neil's totally right. We just have a much more dynamic economy than I think we want to give ourselves credit for, And I think we just don't fully understand it too. It doesn't fit into, a simple econometric model. And also we all put everything, we think a recession, it has to be like '08, and it doesn't,
Yeah, that's the corollary. Not every bad thing in the economy causes a recession, and not every recession is as bad as 2008 or 2020, right? Like the 2001 recession, the 1991 recession, they were bad. You don't want to have one, but it's not the end of the world either.
Yeah.
One potential, boon for the economy looking ahead could be a thaw in relations with China. Treasury Secretary Janet Yellen is maybe right now even in China, meeting with top officials there, talking about trade relations. The tariffs have continued to be a sore point, as well as export controls. Do either of you see anything significant coming out of these meetings?
I think this is less about specific deliverables that may or may not kind of come out at the end of this, and more about reshaping the tone. Everybody knows we're not going back to the Hank Paulson, Tim Geithner era of strategic and economic dialogue, where officials are talking all the time and trying to build a kind of deeper, richer relationship. Look, this is a hostile relationship right now, and what the Biden administration across spheres, both on economic issues and others, is trying to do is say, look, we have fundamental disagreements. This basic hostility isn't going to go away. There are certain kind of red line issues for both sides. At the same time, we're the two world superpowers. We need to be able to have open lines of communication and find areas where we can see eye to eye and communicate clearly, and avoid having things escalate into a mutually negative kind of situation that doesn't have to be that way. And so that's why Janet Yellen is there talking about debt relief for emerging markets and some of the export issues. And these are hard issues. There are deep divides between these two countries. At the same time, it's better to have an open conversation about those than just have no communication at all.
Yeah, totally. I mean, up until she, became, the head for life, there was a large contingent at the Treasury that still believed in the convergence, that, that China is going to adopt Western ways and, open up their borders. Once she, became the leader for life, that thought ended in the Treasury. So Neil's 100% right. Our dealings with China are we know what they are. They're an adversary, but it doesn't have to be as hostile as it has been for the last 6 years or so. And I think both sides are coming to that realization. So they're trying to normalize things, but we're not going back to trying to be buddies.
And I think there's a hope that Janet Yellen, with her kind of stature and experience, she's been in these high-level economic diplomacy circles for a long time, can be a good emissary to kind of open up those lines of communication.
Yep.
At least until 2024, and then we'll see. Then we'll see what happens and what the posture is after those elections. But we don't have to look that far ahead right now. But we can look ahead to what's going to be happening in the coming days, over the coming week. Brendan, what's on your radar?
So next week we get the inflation numbers, the CPI and the PPI. So that'll be as you said, the second part of the Fed's mandate. So those will be important numbers. And headline is still expected to come down because food and gas prices have normalized, and also there's a base effect in terms of yearly numbers where last year gas prices are higher and now they're much lower. But the core rate is still kind of expected to be a little sticky. We have a Bank of Canada meeting. They unexpectedly raised at their last meeting, so we'll see what happens on that front. And then in terms of the global data, we get both economic gauges of Chinese inflation and credit numbers, so that'll be important.
Great. There's a lot of Fed speak, I believe, on the calendar as well.
Yeah, there's like a million.
Yeah.
I was just looking at the calendar. There's
Too
million
many.
Fed speakers.
Too many.
Well,
Neil will be busy.
Yeah,
Yes.
So Friday is the last day before blackout in advance of the July 25th, 26th
okay, that
meeting.
makes
So this is their kind of last chance to get ideas out there in the public realm before they go dark for a week and a half.
Neil, is there anyone in particular that you think we should be paying attention to?
So less so on monetary policy. So Michael Barr is doing an event on Monday at the Bipartisan Policy Center on banking. He's this push toward new bank capital rules is a subject of great interest around Washington and around the banking world. We saw that on Capitol Hill a couple of weeks ago. So I think there will be a lot of attention on what they're thinking, what Michael Barr is thinking, the vice chair of supervision, in terms of future bank regulation. I think I'm going to go see Mary Daly at Brookings on Monday too. It's a big committee. It's a lot of voices. I tend to. The simple path is to listen to mainly Jay Powell, also incoming Vice Chair Phil Jefferson and New York Fed President John Williams. But I don't think there's anything that's really shifted in the last couple of weeks that would cause a change, a pivot in direction. As we've been talking about, the jobs report pretty much in line with expectations. We'll see what the CPI number Wednesday looks like. But that's really the last major data point before this meeting. And, all signs are they're just going to keep going. 25 more basis points in 2 weeks.
And then do you think they really are data dependent, or do you think they're a little on autopilot in terms of just 25 every meeting?
I think every other meeting is probably the default, and
that makes sense.
I think, I do think they've gotten out of this thing of trying to use forward guidance with this real confidence that we know what we're going to do. Powell even had a comment in one of the recent press conferences, I can't remember which month it was, where he basically said, maybe we're wrong, and if so, the data will tell us that, and we'll change course. But I think they're kind of getting out of the business of trying to predict with absolute confidence what they'll do in the future, and really do want to listen to the data. But I think as a baseline, rate hike in July, take September off, do it again in late October, early November at that meeting. But that's. The data could surprise us in any number of directions.
Yeah, and that kind of happened with the pause. I think they had agreed to do it as the data at the beginning of the month was a little bit soft, and then the data of the second half of the month, leading up to the meeting, was much stronger. But they had already kind of agreed to pause, so they couldn't lose face and look wishy-washy, so they paused.
Yeah, that's
which I think was the right choice. But
that's the problem with telling people what you're going to do so far in advance, is it reduces kind of tactical ability. And remember, this time a year ago, they did this thing where they had signaled all along we're going to raise 0.5%, and then they did 75 basis points with only a couple days kind of signaling. So I think they prefer to kind of move in a very steady, gradual way. Sometimes the data doesn't cooperate.
Optionality is the name of the game right now. All right, everybody. Well, thank you for joining us today. Thank you for listening to the Macrocast. Again, I'm Ylan Moy with Penta. Brendan Walsh from Markets Policy Partners was my co-host today. Thank you so much to Neil Irwin of Axios for joining us. His books, again, are The Alchemists, 3 Central Bankers in a World on Fire, and How to Win in a Winner-Take-All World. We hope you enjoyed our show. Please remember to like and subscribe to the Macrocast wherever you get your podcasts. Thanks for listening.